Laurie, let's get into the upgrade. It's a very subtle, slight upgrade. You've got a range of models to work through. Which one is the more constructive one, and which one is the less so constructive one?
So the least constructive one is sentiment. And, I'll couch that by saying we thought sentiment was a problem for a couple months. Nothing's really changed in the last couple months. We're hanging out at one standard deviation above the long-term average on the AAII survey. And that's consistent with kind of a little bit of a breather in the market, kind of flat returns over the next 3 months. And we haven't gotten it yet. The more constructive data points, I would say one is actually our earnings yield gap analysis. If you look when the earnings yield gap is flat and you go back to the late 80s, average return in the S&P is about 13%. So that can get you north of 5,400. If you look at the one that's changed the most since the start of the year, that's had the most bullish move, it's the economic data and the economic model. So to start the year, consensus was looking, I think, for around 1.3% on GDP for this year. 0 to 2% is economic purgatory. Stocks don't do well in that kind of environment. There's this constant, oh my God, are we about to have a recession? Does that sound familiar? That's what we've been, basically hearing the last, year or so, frankly. But now the data is pointing to about 2.1% this year, and 2 to 4%, a very favorable range for stocks. And I think the average return's around 12%, so that's what we've got baked into the model. Your most bullish year, you actually saw, I think, a move about 34% that year. Now, that's not baked into our model, but it just goes to show 2 to 4%, people feel good, and that's what we've just entered.
The character of this rally seemed to shift in the month of March. Energy started to pick up, the banks started to pick up. Tech pretty much did nothing last month, barely got talked about. Do you think that's a sustainable trend going into April and beyond?
I think it is, and we downgraded tech back in January. We look at median PE multiples when we pick sectors. I know the market is technically cap weighted, but stock pickers, people I talk to, portfolio managers, they're picking individual stocks. And if you looked back to kind of 6-9 months ago, your median tech stock was around the long-term average in terms of its forward PE, and that really shot up at the end of the year and was almost as expensive as the industrial sector, really just one of the worst sectors we saw. So we think you've kind of lost the valuation appeal, and I'm not even talking Bank 7 here, but just of your typical tech stock. And I think things like energy are very cheap, financials are very cheap, materials has been on the move, even utilities had a good end to the month, and that's a sector, a couple weeks ago started looking really attractive on our valuation model. So I think this market wants to rotate, and it's starting to happen.